So I believe we are in a recession right now as I film this here, May of 2022. And the data won't tell us this for a little bit longer, but I believe the trends and some of the things I'm going to share in this video can make the case that it's happening. Recession is here. It could be one of the worst since 2008. That's the most recent one in my lifetime. It's really important to think about why this is happening and how it can impact your money. So in this video, I'm going to share what a recession is, kind of talk about the reasons that we're here right now, and hopefully give you some insights on how you can prepare moving forward. Let's talk about it together. All right, so welcome back. Hey, I took a couple weeks off to have a child, and I'm glad to be back putting out content like this for you every single week. I talk about money. I share the lessons that I learned after building and selling my tech company. And I just want to pass those things along to you, learning as I go, documenting it really here on the channel. So if that sounds fun and interesting, consider hitting the subscribe button. I'd love to have you join us, and I really appreciate it. So before I start rambling on about recession, I want to know, do you think we're in a recession? Like, do you feel that in your personal life? Are you getting that sensation that things are really unstable or negative? Let me know in the comments. I'd love to hear your feedback because this is kind of split. There's a lot of people that say, hey, I think things are really bad. And there's plenty of people that say, no, the underlying economy is strong. We're just experiencing some sector inflation and some supply chain problems, for example. I'm in the camp that says, no, there's definitely something fundamentally wrong with the economy, and we are going to feel some pain now and into the future. And so let's start with the definition of a recession, which is simply 2 quarters of negative GDP growth. So negative growth, that means the economy is essentially contracting, shrinking. The output of our country is not the same as it was, and that is a trend measured by 2 quarters. And if you just turn on the news, there's a lot of speculation around this, but there's always speculation around the next impending stock market crash or when we're due for a recession. Because recessions can be healthy. They can bring valuations of companies back down to reality. People don't have as much capital available to go invest in random cryptocurrencies or NFTs or some of these more speculative assets. And that is normally a process that you want to see over some cycle to keep the economy and keep the capital markets healthy. But more recently, sentiment has definitely changed. There's a survey out from CEOs on if they believe a recession is coming, and they overwhelmingly do. And I think that is going to start to be a trend you see even more prominently moving forward. And so why are these CEOs and others and myself so confident that we are in a recession? Well, we're using some data because back in April, there was actually a report that came out that showed the US economy shrunk by 1.4%. So when you think of those criteria, 2 quarters of negative growth, well, we've checked one box already. We're already halfway there. And now, here in the next quarter, that would be that following measurement, there's a lot more economic uncertainty and trouble. If you look at the stock market, which we'll talk about more, there's been a lot of pain and a lot of selling and a lot of money sucked out of the economy. A lot of people are laying people off. And so the things that you would expect when you're in a recession, we're seeing them more materially right now. And I've pulled up this chart that's really interesting that shows GDP on a quarterly basis, kind of in a recent snapshot. And of course, you're going to notice COVID. And that was really March 2020 when we saw the massive stock sell-off. People were freaking out, rightfully so. But I'd like to just frame that and say that the COVID negative economic impact was really this, what I would call an artificially paused economy. Like, these weren't naturally occurring reasons that the economy just slowed. This was almost a global government pause on closing businesses, regulating just the economy on a much more emergency basis than what would normally happen in the market. And that's why we saw such a huge boom when things started to open back up. If you look at charts, you'll just see that the stock market took off. And this is primarily because the economy was now let back to do its thing, mixing that with tons of capital injected into the markets by the Fed. But if you zoom in right there to that recent quarter of 2022, you'll see that little blip, 1.4% negative in GDP, And that to me is a start of what will inevitably be a second quarter in the red. Okay, so you may be asking, how did this happen, right? We just got through COVID. That was pretty tough. The economy was roaring. Things seemed to be going really well. And why is this happening all of a sudden? Well, I think the answer really comes back to inflation. And you've heard me talk about inflation on this channel quite a bit. We are experiencing some of the highest inflation in 4 decades, the highest of my lifetime. I'm not familiar with what it's like to watch prices go through the roof and to know that my money is effectively 10% less valuable than it was just a few years ago. And inflation is what scares investors. Inflation is what erodes capital. And essentially, it's what's causing a lot of this pain in the economy. Because as you may remember in previous videos, the Fed basically printed trillions and trillions of dollars. They just created money out of thin air. They injected it into the economy under this premise of COVID and emergency response. But really what it did is it inflated everything. We saw asset prices like homes and used cars go through the roof. I mean, my car, I have a paid off 2012 Ford Fusion. That car was like maybe $7,000, the Kelley Blue Book value. And it almost doubled because of this inflationary crazy situation that we're in. That's unheard of. And so effectively, the Fed just really overdid it with this quantitative easing and putting all this capital into the economy. And if you remember, I could do a whole video on this. If you remember, we were lied to with this idea that, hey, inflation is transitory. Do you remember this word? If inflation is just this temporary phase, we went through this blip, we injected some cash, it's all going to be fine. That's not true. It never was true. It never is true. This is something that was inevitable. And most people were screaming and saying, wait, why are you doing this? Why are we still propping up the economy and putting all of this printed money into the system? We don't need to do this. And in fact, those decisions and the dishonesty about their impact are the reason why we are in the situation currently. And the Fed is forced to hike interest rates. They're forced to basically cool down the economy. They're wanting to bring things back to somewhat of a normal place so that inflation does not spiral out of control and really get things in an irreparable, perhaps, place. But with that comes the risk and likelihood of recession. And we're already seeing these rate hikes, 50 basis points, that they just announced. And those will likely continue until some point here in the future. Okay, so how is this impacting the stock market and my investments and your portfolio? Well, you've probably seen a lot of red days. In fact, there are 7 straight weeks of declines in the S&P 500, which is the worst since 2001. That's a lot. That's terrible. And you can see that in your portfolio. I believe I read a stat, I'll try to pull it up, that the stock market is off to its worst year since 1939. That's almost 100 years that the stock market hasn't sucked this bad. And, for someone like me, I'm right in the middle of it at a peak of my investing years. And so let's go ahead and look at some charts. I want to focus specifically on the S&P 500. I'm going to look at the VOO, which is the Vanguard S&P 500 ETF. I've done a video about this. You should check it out. It's something that you should consider investing in. I own it. I'm a big advocate of that fund as a long-term investment. So since that negative GDP print took place in April, you'll see that the S&P 500 has actually fallen about 9%, which is only about half of the amount that it's fallen from its peak, which is about 20% of a drawdown, which officially means the S&P 500 is in a bear market. There's this negative 20% decline, and that signals that the trend is now to the downside. And we've already seen this over in high-flying tech stocks. Things like the NASDAQ are down even further. Things like what I hold in my portfolio, like Coinbase, some of my positions in Coinbase are down 75%. And a lot of the people on CNBC and these experts in investing, they're kind of smug at the idea of people like me or you who have invested in higher tech growth names like Coinbase or others, because they're down so dramatically. But you have to remember, these are companies that like PayPal and Square and Shopify and Coinbase and internet companies with a lot of innovation and technology. those are not bad investments in my opinion. They're bad investments right now, and these people are really focused on the shorter term. When you're focused on the long term like I am, this point in the market is actually kind of exciting because things are much cheaper. They're much more affordable. You can get more shares of your stock that you like, and that I believe it really will correct and appreciate over time. Because if we zoom out a bit on VOO, you can see this chart that shows the bottom of the COVID crash of March 2020, and we just shot way up. It was incredible. Some people may have timed it and sold at the top, and good for you if you did. That's fine. But we're coming back down. We're coming back down to reality. And what that really entails is the multiples are compressing. This means the price to earnings, those ratios of how much you would spend to own stock in a company, it's getting lower. And that's not a bad thing, but you can see that reflected in the chart. And if we jump over to a chart of SPY, which is basically just another S&P 500 ETF, and go look all the way back into the 90s, you can see some of these big drawbacks, some of these recessions and crashes from 2000 to 2008. And there's March 2020. And now you'll see where we are kind of in comparison to that. And it does look pretty bad. In fact, it looks really dramatic in the way that it's sold off so fast. But there's an overwhelming trend across that kind of 30-year snapshot, and that is that the stocks want to go up. They will consistently go up. And in times of volatility like this, it's important to know what you own. Think about how you could buy more and do so for the long run. Okay, so what am I doing to protect myself against the recession, and how am I changing my investment strategy? Well, I don't have a good answer for you, actually. So I'm resetting, and what I've done is I'm buying a lot of VTI. That's the Vanguard Total Stock Market Index ETF. I've done another video about that. You should check it out. That's really helpful. I'm just owning the stock market. The US stock market is clearly on sale at the moment, so I'm buying it. I'm not picking winners and losers. I'm just buying the thing. I am doubling down a bit on some of the tech names that I believe in. So I've been buying some Tesla. I've been buying some more Coinbase, and I've even been buying some more Square. I did do some selling. So I sold VWO. That's the Vanguard Emerging Markets ETF. And I just felt like there's so much uncertainty in the world economies that the emerging markets, I don't know what that's going to look like in the short term. And for me, I actually wanted more cash. I wanted to go buy some of the things that I knew are so far down that I believe there's a greater upside by moving the money. That's not something I recommend or do all the time, but in this case, that's what I did. And lastly, I'm also starting to focus on stacking more cash away. I know that inflation is just crushing that, but I want to have more cash available to buy these big drawdowns. I think there is more to go. I think there is going to be more pain and more selling, maybe for the next year or 18 months. We'll see. And this video will serve as my prediction that we can call me on if I'm wrong. But yes, I have some cash. I'm also planning to build a home in the next 18 months. So that's kind of part of this equation. Saving up for some of that and also having the firepower to go buy. Okay, so that is a lot. That is my thoughts on recession. Hey, if you are not in a place where you're investing, a lot of extra money and you're just trying to survive, I really encourage you right now to start making plans to preserve your cash. Maybe think about other ways you can generate some income. Limit your expenditures if there's bills or things that aren't critical. I would suggest trying to trim those back. I want you to be in a place of defense so that if things do get bad, you're not caught off guard. You have a plan in place. And if things don't, well, then you're also pretty okay, because that's a possible scenario that things are fine, but I don't think they're going to be fine. And I think we're going to experience some trouble here in the short term. But don't let that scare you. I think of recessions as very infrequent opportunities for building wealth, for building great companies. There's a lot of opportunity when the fear finally subsides and you or I have been heads down working on our plans to really capitalize on that. So think about that. have a plan, stay focused, stay positive. It's the people that build things, it's the people that create value that get through recessions and often do so even in a much better place. Okay, I hope that was helpful. If you enjoyed this, please hit that like button, hit the subscribe button, share the video with a friend. We will be back here with the next video next week. I will see you then.